Let's get to Greg Fleming, President and Chief Executive of Rockefeller Capital Management, which manages the investment portfolios of some high net worth clients. Greg, very nice to speak to you. Thank you so much
Good to be here.
For joining us. So let's look ahead to 2026 then. And I've had a lot of conversations about, on the one hand, resilience, on the other hand, geopolitical turmoil. And I wonder how that makes the US economy look to you in 2026.
Well, Anna, I do think overall the resilience has continued to be there and the economy has hung in. But I do think in the last 6 or 12 months, there have been major pockets of the economy that have been more sluggish, rate-sensitive areas, manufacturing with the whole onshoring and everything going on tariffs. And you see that in the employment data. And yesterday there was an ADP report that was actually just flat out not good. So we'll see where it goes from here. I think there's a Department of Labor report in a week or two. But employment has been sluggish, and there are major parts of the economy that have been sluggish. However, overall, it's held in. And obviously, part of the reason it's held in is AI and all the investment in AI. We expect that to continue. Yeah. We also expect in 2026 there to be a significant amount of stimulus. You have midterm elections late in 2026. So, from a fiscal standpoint, the government's going to do what it can to keep the economy going. Yes. We think the Fed is focused, and this will impact their decision next week, on the employment data and the weakness in the labor markets. So I expect them to drop rates next week, and I expect them to be focused on that side of the equation, maybe slightly more than the inflation side of the equation in 2026. Okay,
and is that a reason to be a little bit nervous? If we have a Fed that is very much focused on the downside, the labour market story, and not so focused on inflation, especially as you have so much capital expenditure around the AI theme and other things that could push inflation a little bit higher, are you nervous about inflation in 2026?
Well, it's a great question. And look, they've been trying, and it's a difficult task, the last 12 or 18 months. They're toggling the two issues. They're trying to avoid the word that we haven't seen in a long time, really early in my career, stagflation. That's really what they want to avoid. So they're going to continue to try to balance it. I don't think they're going to overdo it on either side. I just think at the margin they might tolerate slightly higher inflation than they prefer. They're not going to come out and say this, I don't think. But the reality is I think that they'll tolerate slightly higher inflation than we've had. In order to deal with the employment side and the sluggish parts of the economy. The other thing, Anna, is that we have a big federal debt in the U.S., and it just continues to move forward, 5-6% of GDP. When Scott Bessent, when the administration came in, Scott Bessent, the Treasury Secretary, said they were focused on 3%, 3% real growth, 3% inflation, and 3% budget deficit. Yeah. We're not going to hit the 3% budget deficit. One way to deal with that is to have higher overall growth, inflation plus real growth. And if we're in the 6 to 7% range, that helps with the debt situation. And if rates are a little bit lower, that helps with the cost of the debt. So we think that's all going to be factored into the mix, and it'll cause the Fed to be slightly more focused on the employment side.
Yes, and we can wonder whether we might get those rate cuts, but if the world is worried still about inflation, we'll see what that does to the cost of borrowing in the United States. AI is clearly a big area of investment for many corporates, hyperscalers in particular in the United States, Greg. How much positivity does the AI story deliver for the US next year, do you think? Because on the one hand, many Western economies are facing demographic challenges. I was talking about this in the earlier part of the programme. On the other hand, AI can deliver on productivity and help us solve those challenges. Are you an optimist? Do you look at that as a positive story?
Yes, I am optimistic on this. And I've seen in my career now, a number of breakthrough technologies. I think AI will be the most transformational of anything that we've seen to date. I think that every single company in the United States and probably around the world, but I'm more familiar with the U.S., is focused, public and private, on how to incorporate AI into their businesses to make them more efficient, to accelerate growth, to expand margins. So, and AI is immediate, Anna, in the sense that it's here. Yes. The tools are already available. They get better every week and month. So I am optimistic that AI is going to have a significant impact on the American and ultimately the global economy.
And a few sectors will be spared, perhaps, including the management of people's money, the management of wealthy people's money, perhaps. I wonder what impact you think AI is going to have on your sector.
And actually, before I go there, I think no sector spared. I think that every business will be reshaped by AI. In our business, the bulk of the work with clients, which is done by our, we call them elite private advisors, that will continue, the client interface. But the work of the team will be made more efficient by AI. So as an example, we may have a team of private advisors working with 20 families that have $50 million each. They might be able to have 40 families with $50 million each, in a couple of years as we integrate the tools into their business model and what they do every day. And that's the type of impact that I think AI could conceivably have across many industries, which is why there is the promise of greater productivity and greater economic growth as a result of AI.
So you don't think necessarily it leads to reduced face time for individual clients with their money managers? It's more that those money managers can have more relationships.
Well, definitely in our model. Our model is a high touch. We're focused only on high net worth and ultra high net worth families. And our services are intended to be comprehensive. We help them with investments, but we do generational work with them. We are focused on after-tax returns, financial education, philanthropic advisory, all of it. That requires a direct face-to-face interface between our private advisors and the families we advise.
There's a lot of focus on private markets as well, Greg. Are you in the camp that says, oh, look out for cockroaches, there's got to be some more bad apples out there? Or are you in the camp that says, actually, the leverage part of this is really quite small and it's just a big asset class, it helps to spread the risk, and you're positive?
First, let's scale it and size it. Private markets were mostly private equity and a little infrastructure 25 years ago, and was about $1 trillion market. It's over $15 trillion today, on its way to $20 trillion. It's a significant part of the investment portfolio for all, or should be, high net worth and ultra high net worth families. So it's not, a small little thing on the side. It's central to investing today. So, for us, it's an important part of our clients' investment diversification. Our clients, because they're high net worth and ultra high net worth, they can handle the illiquidity that comes with private investments. So we think it's here to stay across a wide range of asset classes.
Yeah, maybe they have that long-term mindset. Greg, thank you very much for joining us. Very good to speak to you. Greg Fleming, President and Chief Executive of Rockefeller Capital Management.